While some online bullion dealers continue to charge $4 over spot for U.S. Mint Silver Eagles, SD Bullion is selling 2016 Silver Eagles for just $2.29 over spot for any quantity. Again, that's just $2.29 over spot for any quantity. If you haven't joined over 25,000 new customers by making the switch to SD Bullion, what are you waiting for? You could save hundreds or even thousands of dollars on your next order. SD Bullion, the lowest prices, period.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Joining us for this holiday edition show is our good friend from the other side of the pond, Alasdair Macleod.
I was a bit worried you were going to say the other side of the closet. I don't know where that came from.
I was trying to say the other side of the cloud, I think.
Take your head out of the clouds, Alasdair.
Anyway, it's nice to be with you. It's very nice to be with you.
Well, maybe that'll be a sign we'll have a light show this week here. After a very strong first half of 2016 for gold and silver, the last week or two we've been in correction mode, Alasdair. What's your take on where we're at in the markets right now as we record late in the afternoon, Eastern time here on Thursday, and in the evening in London time here on Thursday? Gold's trading right about 12.20. Silver has been trading right around 16.30 to 16.40 throughout the day here. So what's your take on the market action we've been seeing the last couple of weeks?
Well, I think what you've said is sort of more or less covers it all. We are in consolidation mode. We've had a very, very good first quarter. It continued to run up until the last week of April, and in that sense, I think for gold to come back to around about the 1200 to 1220 level would be a perfectly normal correction. But having said that, we ran up to record open interest on COMEX. Then the record figure, I think, was just over 600,000 contracts earlier on in May. I'll try not to be too specific about dates because I actually don't have it in my mind. But what's interesting is that the overbought level of gold was actually historically just absolutely amazing. But then what happened was that it became clear that the bullion banks, mainly through their swap positions, threw out uncovered shorts until it basically just took out all the demand from the managed funds category. And you can see how this huge weight of selling eventually just drove the price down. It took the top off the price. And I reckon that just looking at the numbers, I think that the swap category probably made between $150 and $200 million on that trade. Because they have been closing the position. Open interest has fallen very significantly over the last 10 days. It's fallen from over 600 down to, I think, around about 15,000 contracts. So this is it's just, you run them up, short it huge, and then you buy them back on the drop. And I think they've probably made as much as $200 million. That's what I'm afraid what this market is about. And until we get something that really does clean out the vaults, and by this I mean Western demand rather than Chinese demand, I think until that happens, you will find that the bullion banks still continue to play those games.
And to put that in perspective, too, was it not the case that, if memory serves, in January, we were under 100,000 on open interest for contracts, or maybe later portion of December. Likewise, with your comment about dates and data, my memory is not accurate on this, but I know that it was really, really low. And we have moved through this, accelerating bull move, particularly since midway through January all the way through now, where there's been an enormous amount of interest, people wanting to go long, paper allies to our physical desires of gold seeing higher prices, but at the same time, the short interest has matched it. And the bullion banks can do that. There's no restrictions on them whatsoever, with the exception of the constraint that physical would impart at some point. It's always an open question. When is that going to be a restraint?
Well, exactly.
Or how?
Basically, it becomes a restraint when people stand for delivery, and so far that hasn't really been the case. What happened earlier this year was that negative interest rates, particularly in the Eurozone, and perhaps Japan to a lesser extent, but particularly in the Eurozone, has driven people into buying gold, because obviously the cost of owning gold was becoming less than the cost of leaving money on deposit in a bank. So you can see that is why, in particular, the sales of ETFs, physical ETFs, really took off. And I think I'm right in saying in the first quarter there was something like 350 tons of net purchases going into the physical ETFs around the world. Now this is quite a lot. Fortunately for the gold bears, as it were, at the same time, Chinese demand and Indian demand has sort of dropped off a little bit, and particularly in India, there was a jewelry processors strike, which really meant that we saw very, very little in the way of imports going into India. Chinese imports died off a little bit, but at the same time, the demand suddenly was switching into, I think, into mainly Europe with these ETFs. So that I think is going to be increasingly the driver in this whole situation, because negative interest rates are not achieving what the ECB wants them to achieve, or for that matter, the Bank of Japan. And so what do? They don't say, well, that doesn't work, so we'll go back to zero interest rates. No, they say, we'll just chuck more unusual measures at it, until someone gets the message and goes out and borrows money. They just, they've just got completely the wrong paradigm. They don't understand what they're doing. They're sort of, if you like, on a road, and they're just riding that road right to the end until they hit a brick wall. And meanwhile, of course, this is very, very good for demand for physical. And that, I think, is becoming the driver. And at some stage, it's going to be increasingly difficult for the paper merchants to actually ignore it, because they will either be called upon to deliver, or they won't be able to cover in the markets, which is the other thing, because occasionally they are actually forced to go and cover in the markets. And the way this happens, in particular in London, is when people have unallocated accounts, they begin to decide they would rather have allocated accounts. So if we start seeing problems in the Eurozone banking system, which I expect any day now, when I look at what happens to the share prices of some of the majors, and of course everybody knows that Deutsche Bank's share price has been absolutely trashed. You begin to think, well, should I be having my systemic hedge in the form of an unallocated account with the Eurozone Bank? You begin to think, well, this is probably not a sensible way of doing it. So, you then move over to an allocated account, and you find that, surprise, surprise, the bank doesn't want to deliver the stock into a custodial account for you. So that, I think, is a test which actually cannot be all that far away.
Have you seen any indication that allocated storage is on the rise vis-a-vis, paper in London?
We have no statistics. The LBMA provides no statistics, and so far as I'm aware, the bullion banks don't provide statistics to the LBMA. So it's a complete. It's just nobody knows. It's impossible to know. All we know, do you remember after the Cyprus debacle, and I'm going back to when, I think it was 2012. In February 2012, Cyprus fell apart. They did the first bail-in under pressure from the ECB. The whole thing was the most awful mess as far as Cyprus was concerned. But shortly after that, the alarm bells that were ringing around Europe as a result of that, people were starting to move money out of deposits in banks which they felt were at risk into banks which they felt were secure, which in those days were banks like Deutsche Bank. But at the same time, and this wasn't observed at all, and so we have to deduce this ourselves because there was no information on this. But at the same time, we saw that customers with ABN AMRO and Rabobank, the two Dutch banks, were notified by those banks that they would no longer deliver bullion to their customers. In other words, what they were saying is that you either have an allocated account with us. If you want to change that into an allocated account, tough, we're not going to do it. Now, this sort of rather indicated that there was actually a run on bullion within the London bullion market. And surprise, surprise, shortly after that, what happens? You get a coordinated knockdown which drove the price of gold down. I think it was April 2012, drove the price of gold down over $100 in 2 days. And rescued
April 13.
That's it.
April 2013.
It was 2013. Sorry, I'm a year out. I'm not very good at my numbers today. But it was no coincidence that actually happened, because it rescued the bullion banking system in London from what was developing into a run on their gold stocks, on their very limited gold stocks. And remember, they're fractional reserve banks, just the same as a fractional reserve bank running dollar accounts, deposit accounts is. So they were in trouble. And that is the only conclusion you can really come to. Of course, none of this was made public, and very few people would actually know that it actually happened. But if you observe the market very closely, my goodness, you knew there was something going on, and I think that was the logical conclusion. So I can see that sort of problem re-emerging, being driven by a combination of renewed worries about the banking system in the Eurozone and negative interest rates.
And the problem for the cartel now, Alasdair, is back in 2013, they had a lot more room to work to drive the gold price down $100 or $200. Right now, after a 5-year correction in early stages of a resumed bull market, it'd be a lot more difficult to do that.
I quite agree. I think that's absolutely right. The other thing that's interesting this time is that some of the big money, billionaire type money, does seem to be moving into gold. We see this. I think it's been widely publicized that the Soros Foundation or family have been moving into gold. And this is someone who basically I think is pro weak money and against sound money. So this is interesting. I think this big money is actually now beginning to move towards physical gold, and it's going into physical. I don't think it's going into sort of paper equivalents.
Well, I would love to see a lot more high net worth people recognizing the allocated storage quandary and you actually going for more physical. Do you have any indication as far as people and of a high net worth accounts beginning to approach physical? I mean, I don't know. I mean, when I look at Soros, for example, his filings indicate that he went for a rather large chunk of Barrick mining, and then also I believe it was GLD that he had purchased.
It was. Yeah, it was GLD, and I think as far
as Druckenmiller is probably the same.
Yeah, absolutely. I think as far as those guys are concerned, owning GLD is the equivalent of owning physical. They're
because of the size and the fact they can do the basket redemptions for physical gold. Is that what you mean?
No, I don't think so. I think it's just they're not actually thinking in terms of systemic risk. I think what they're doing is, they're thinking, okay, if we actually have physical represented by GLD paper, that actually does get money, my money, out of the banking system and into bullion. Okay, it's still securitized, but it is one step safer than having money sitting in a bank, if you like, or having an account with a bank, a gold account with a bank. So I can see where they're coming from, because these people, they have made their billions out of the securities markets, and that is the way they think. They don't think in terms of necessarily owning the physical directly themselves, vaulted in their name. Because apart from anything else, they're traders. They're not. They probably sort of think. This is the other thing which I find fascinating about the current situation, and that is that when fund managers go in and they buy gold, they're not necessarily buying gold. What they're doing is they're selling the dollar. That's probably the way they're looking at it. They're saying to themselves, right, we think the dollar is going to go down. How do we profit from that? Well, you sell dollar for gold. So it's. I think it's actually that simple. They've also, I think, been driving up the oil price on exactly the same basis. If you think the dollar's going down, buy crude oil futures. Mm-hmm. So, this is the confusing thing, I think, for anyone trying to work out what's going on in gold. It's not just gold. It's what gold is measured in. It's that's probably driving it rather than the gold price itself.
That's a pretty good segue to talk a little bit about what's going on in the latest chapter of our currency wars. I mean, it's of a couple weeks back, we sliced all the way through the DXY 92, and the momentum to the downside for a depreciating dollar vis-a-vis the yen and euro in particular, which is just pretty strong. And it looked like part of the reason why the policymakers and the Federal Reserve chose to amplify what they had cherry-picked out of the April FOMC minutes, combined with what is probably in a 2-3 week period on par with the most jawboning for interest rate normalization that we have ever seen. I mean, ever. I'm curious what you suspect is going on in terms of how the U.S. dollar and economic policy is interfacing with, the way in which the policymakers are trying to argue for interest rate normalization and how that will, hook up with precious metals going forward.
Yeah, I think, I have talked about this before, and the way I look at it is that it's actually got a lot to do with China. China sits on huge quantities of dollars, as we know. China has her 13th five-year plan, which started, I think, in February this year. And under that plan, she intends to move her economy from, manufacturing cheap exports, if you like, for the rest of the world, into technology, consumer items, if you like, sort of developing the consumer market for her growing middle class, and importantly, bringing about an industrial revolution throughout Asia. We are talking about an industrial revolution that encompasses billions of people. And so the amount of capital investment that is involved is absolutely enormous. And what this involves basically is that she will be selling down her stockpile of dollars in return for commodities. That, I believe, is actually what is driving the value of the dollar. If you measure the dollar against commodities, you see that the dollar is going down in its purchasing power quite significantly. Okay, there's been a little bit of a sort of if you like, a consolidation in that downward trend of its purchasing power in over this month. But basically, that is the direction. Now, if that's the case, then you can see that the price of commodities in gold could remain relatively stable overall. But because the dollar is going down, the dollar price of gold, the dollar price of oil, the dollar price of copper, and so on, those dollar prices will be going up. Not because the commodities are going up so much, but because China is a seller of the dollar. And remember that she has actually laid the path for this. She's done two things last year. The first was, well, in fact, there are three things. The first thing that she did was she finally managed to become part of the SDR after many years of pressuring the IMF to let her in. That's finally happened. The second thing in all this is that she has set up the institutions to finance the expansion, the trans-Asian expansion. We're talking about Silk Road, we're talking about electricity, we're talking about all these things, and that is in the form of the Asia investment, the new Asia infrastructure investment bank, which is based in Shanghai. She has also set up a BRICS bank, which is the equivalent of the World Bank. That again based in Shanghai. So she is assembling not only putting her currency into a position where it can become central to all this, but she's setting up the institutions around it, which will be required to expand the markets for her currency into her immediate trading partners. And the last thing she's doing is she's pricing the main commodity that she requires, which is energy, in oil. So there's a yuan oil contract now, or I think it's about to trade or it's already trading in Shanghai. She has already done the other thing, and that is ensure that the yuan trades in sound money, which is the gold contract, and that again, you can trade in yuan, gold for yuan on the Shanghai Gold Exchange. So these things are all sort of coming together. So she's getting away from dependency on the dollar. Not only that, but she says she's no longer targeting the yuan against the dollar. She's going to target the yuan against a basket of currencies. Now, that can be anything. I mean, it's whatever the PBOC chooses. But you can see that this is freeing her up to reduce her stockpile of dollars. So you've got huge quantities of dollars which are going to be coming onto the open market. And at the same time, you have got Saudi Arabia, which is in financial difficulties. Her budget deficit is enormous. She's getting a little relief, I guess, from the slightly higher oil price, but it's nowhere near enough to for her to balance her budget and for her to get away from this requirement to top up her oil sales by borrowing in international markets. So you have got sellers of the dollar suddenly. So we've moved away from 2015 when you had commodity-related businesses going bust. The banks were telling them, sorry, we're not going to roll your loans. We expect you to repay as they come due, so that commodity producers and countries which relied on commodities were finding that they were having to buy cash dollars in the market in order to pay back to the banks. That was driving the dollar up, and it was driving commodity prices measured in the dollar down even further. So the purchasing power of the dollar was rising because of that. Now it is going the other way, and it's going the other way, I think, with a vengeance. And that produces another problem for the Fed, because if you get a fall in the purchasing power of the dollar, any more than we have had so far, the rate of inflation measured by the CPI in America is going to breach that 2% level by a fair margin by the end of 2016. What does the Fed do about interest rates? She's sitting there. If you have the CPI running, say, at 4% or 5%, which I think is quite possible at the end of this year, what should the interest rate be in order to stop the slide in the purchasing power of the dollar gaining yet more momentum? Interest rates should be far higher than they are. So coming back to gold, this is interesting because really what we're describing is a situation where, because the purchasing power of the dollar is going down, price inflation is rising, yet the economy is stagnant. This we called in the 1970s stagflation. We have got exactly the same thing coming back. Through the 1970s, interest rates started low, and they rose over. I mean, obviously they fluctuated considerably, but they started very low, and they went up to sort of well into the teens over that time. And yet we had a massive bull market in gold. The cost of owning gold in nominal terms was absolutely enormous. But the problem, I think, that this is something that so few people today understand, is it doesn't matter what the nominal rate is. The question is the nominal rate enough to stop the slide in the purchasing power of gold? And the answer clearly is no, so long as the Fed is reluctant to raise rates to stabilize the dollar. Why don't they want to raise rates? They don't want to raise rates more than 1 or 2% for the very simple reason that they would collapse the whole financial system. Think what happens to government finances. Think what happens to all that those bad loans which are sitting there, and they are huge in quantity. So we have got the potential, I think, for an interest rate dilemma coming up in the coming months. So coming back to gold, we see a consolidation. Does this consolidation mean that the gold run is over? I don't think so. What I see is actually something developing which is actually very, very serious, and that is uncontrollable price inflation without any increase at all, really, in industrial production. And this is something that central banks don't understand. They cannot divorce price rises from demand. They think price rises are simply the result of demand. It's not. It's the result of the dollar going down. And that's the bit they don't understand. So it's going to be fascinating to see them rerun the 1970s. And I think that's what we've got in prospect.
Yeah, I'd agree with that. And it was clear that they all believe that at some point that they could control the process of inflation and contain it, but still flirt with a lower dollar. I mean, it's very clear that the policymakers within this year have decided that a lower dollar is in the interests of keeping all of these spinning plates up in the air.
Yeah, I think we should draw a distinction between dollar exchange rates against other currencies and the purchasing power of the dollar in terms of commodities and goods and services. Because before we started talking, we were sort of knocking around the idea of this Shanghai Accord, and I think we sort of agreed between the three of us that there wasn't much evidence that there is a Shanghai Accord, other than perhaps in a few journalists' mind. But there is no doubt in my mind that because the dollar is the reserve currency, the way the central banks, the ECB and the Bank of Japan and the Bank of England, plus the Swiss National Bank and all the rest of them, the way they think is, what is the currency against the dollar? What's the currency rate against the dollar? In the case of the UK, we also think about what is the rate against the euro. But basically, everyone ties themselves to the dollar. So if the dollar starts going down, don't think that it's because the euro is going up or the yen's going up. No, the dollar is going down in purchasing power against the things, hard things like commodities and their derivations, manufactured goods.
To give the listeners a quick update on the physical markets of gold and silver, a couple big developments in the silver market. This week, finally, the Canadian Mint released their Q1 sales. So the Royal Canadian Mint doesn't release their sales weekly like the U.S. Mint does, unfortunately. But the numbers were very impressive. In Q1 of this year, silver maple sales were 10.6 million coins. And to put that in perspective, guys, last year, 2015, which was an all-time sales record for the Royal Canadian Mint at 34.3 million ounces. Q1 came in at 8.9 million ounces. So we're looking at about a 15 or 20% rise year over year from previous all-time records. Right now the Royal Canadian Mint's on track to sell over 40 million ounces of silver maples this year, compared to their previous all-time record of 34 million ounces. The U.S. Mint here on May 26th has sold just shy of 23 million coins. And again, they are still on pace to sell just under 60 million coins for the year. So between the two biggest worldwide official mints of the U.S. Mint and the Royal Canadian Mint, you're looking at close to 100 million ounces of silver in a single year if demand continues for the second half of the year, which is quite astounding.
Do we know how many tons that is, roughly, off the top of your head?
Yeah, we can do
it's about 3,000 tons, isn't it, or something like that?
It's ballpark, yeah. It's a pretty significant amount of silver for just investment demand. And we're talking just two government coins. We're not talking about all of the other government mints, whether it's the Perth Mint or the British Mint or the Austrian Mint, as well as all the privately minted rounds, bars, and so forth.
This is interesting because, we're looking at a commodity which is, as much as anything, a byproduct of the mining of other minerals, like sort of zinc, tin, and so on. I think production of those metals has gone down somewhat So even though the silver mines would presumably, I mean, a lot of them are cash strapped, they'll produce as much as they can. I think the supply side is probably sort of quite quiet. I should think that the industrial users, like solar panel manufacturers and all the rest of it, must be rather worried about where they're going to secure supplies. Do you think that's why the silver price has been holding up so well? Sorry, it hasn't really been holding up. Well, it has in recent days. I mean, when they've tried to hit the silver price, it hasn't really gone down. Gold goes down, but silver holds up. Do you think that might be one of the reasons why this, the fact that you've got this investment demand clashing with industrial demand, and perhaps the industrial boys beginning to worry about where the silver's going to come from?
Yeah, it's an excellent question, Alasdair, and really a perfect segue to the other big physical story of the week here. Bloomberg, and it's quite amazing that Bloomberg released this interview, but they interviewed the CEO and president of First Majestic Silver, Keith Neumeyer. And for those who don't know, First Majestic Silver, I think is, correct me if I'm wrong, Eric, I think they're number 2 silver miner in Mexico. One of the leaders.
Yeah, as a primary miner, yeah.
Right, as a primary miner. So again, they're a primary silver miner, but one of the leaders as far as primary silver mining. And First Majestic told Bloomberg here today that one of the major Japanese electronics companies has been in talks with them, trying to lock up future silver supply, that citing concerns over the availability of physical silver. So exactly like you're saying, Alasdair, certainly could be early indications that industrial users are concerned about the future available supply. And this is something that we've warned about for years, that the electronics industry, silver is such a small component, but it's such a crucial component. I mean, you're talking about companies like Apple, Samsung, and companies like that, I mean, they're not going to sit around and let their production facilities be halted on making the new iPhone 18 or whatever the model is at the time over $3 worth of silver in a phone. I mean, they're going to do what it takes to make sure they've got supplies on hand. So, in my opinion, if they have any hint, any sniff of a fact that they might have problems sourcing silver, they're going to lock up a few years' worth of what they need to make sure that they don't have to worry about stopping production over something as trivial as a couple of dollar component in a $500, $600, $700 phone or tablet or TV or computer or electronic device.
Yeah, and I think it's worth making the point that the silver markets are essentially non-cyclical. So you could easily see reasonable growth in demand, industrial demand for silver, despite a really sort of rather flat global economy.
Yeah, made all the more interesting because as we get a flat global economy, investors will, generally speaking, be more positive towards precious metals, which will give a big boost to demand and the competition between the industrial and investor segments. A lot of people assume that a slowdown in the global economy will hurt silver because of the industrial demand, but I frankly think that the market is so tight, this competition that we're speaking of, in fact, is going to assert itself later this year, even at its earliest. We'll see.
And it just compounded by all of the mines that silver is a byproduct, with the hammering in the price of copper and the other base metals, that for those firms, it doesn't matter if silver's gone up 20 or 30%. If copper's still down 60% and they've cut production, I mean, the hammering of the base metals is going to have a big impact, in our opinion, going forward on the supply side of silver from all those big mines, which are a bigger component of the silver supply than the primary silver miners.
Yeah, absolutely. It is an interesting one, I must say. And in terms of performance this year relative to gold, silver actually has been left behind. So I think there's plenty of scope for silver to outperform in the coming months.
Well, we would be remiss if we didn't ask you what your take is as far as this Grexit. Grexit. We're doing great with data and names here. Brexit vote, and that's coming up in June. It's probably, if memory serves, about a week after the FOMC's scheduled meeting. And, you know, we had that talk about it. Oh, it's a live meeting with a press conference, and that therefore... I forget which of the talking heads were jawboning to the effect that June would be the magic date that we'd see the next interest rate normalization push. But that's not likely because of Brexit. They don't necessarily want to upturn the apple cart and whatnot. But what do you think's going on as far as where Brexit stands, you know, and then how that's going to play out in the summer and beyond?
It's a very interesting situation. I mean, I have no doubt in my own mind that we'd be far better out, but that's my personal opinion. But it is an opinion basic, if you like, on what I would regard as a far sounder economic analysis than what's being portrayed by the IMF and the UK Treasury and the Bank of England and the various other people who are trying to scare us into staying in. It's really about trade. That's what everybody's talking about, and it's the question really of, do we remain in the EU where we have no trade barriers, or do we go out and negotiate our trade agreements, if you like, with whoever we want? Well, the answer actually is you don't need to negotiate trade agreements with anyone. If our government actually had the gumption to understand how a free market economy actually works properly, then they would just, leave and say, okay, China, okay, India, there are no tariff barriers. As long as you manufacture things to the standards that we require, you're free to compete, free to sell anything to us. And I'll give you an example, actually, sort of a really good example of where trade barriers just do not work. China is allegedly dumping steel. China has too much capacity for steel production. Okay, so you can accuse them of dumping, if you like, because the price has gone down. Of course, it's gone down because it can't sell the bloody stuff. So what do? In Europe, we start talking about, well, perhaps we should put a trade tariff on it or something. We talk about something like, 10, 15%. What does America do? Jacks up the tariff against Chinese steel by some incredible amount, 200 and something percent, I think it was. But what idiot politicians just do not seem to understand is that while they're protecting the domestic steel industry, which they can only do for a brief period of time, they're driving up the manufacturing costs of every user of steel in the United States. Car makers and all the rest of it have got to pay inflated prices for their feedstock, for their commodity feedstock. I mean, it's completely ridiculous. So actually, this whole idea that you can have trade tariffs and trade tariffs are necessary, forget it. Free trade is the answer. It's actually quite simple. Let people, if someone wants to sell something very, very cheaply, then why can't we buy it? What's wrong with that? I'm quite happy to do so. And so I think, we've also got the advantage that, India is now the fastest growing economy in the world, certainly in terms of volume. I mean, it's just absolutely enormous. You've got 1.2 billion people, and they're forming a middle class. They have a caste system rather than a class system. You're going to have literally over the next 5 to 10 years, 400 million people who you might term middle class. These were people who are going to consume more. They're going to consume things which at the moment they probably don't. They're going to consume luxuries. They're going to save more. It's rather like China was, let's say, 10 years ago. This is enormous. They've got an education system which is a legacy from the British. They've got a legal system which is English law, based on English law. We have got to be the number one trading partner for a country like India. So why don't we trade with them? What the hell's the point of trading with Europe and sort of thinking this is where our future lies, when actually what we're seeing is a contracting market in Europe, but all this dynamic opportunity abroad. Unfortunately, getting back to your question, it's proving very difficult to get this message over to people to sort of encourage them to vote for Brexit. Instead, the government is sort of frightening people into, well, there's the unknown. If we go out, it's unknown, it's going to be cold. Hang on to nurse for fear of something worse. That is the approach. I think in all this, one thing which I think is actually completely nonsensical is that we elect politicians to be the executive here. And if they fail to deliver, then we have the opportunity once every 4 or 5 years to chuck them out. If we remain in Europe, that is no longer going to be the case, because over a period of time, legislative power in particular, will be moving from national governments into the Brussels bureaucracy. And there is absolutely no democratic right to originate any legislation, or indeed to get rid of legislation. And indeed, on top of that, we end up with a situation of taxation without representation. So, yet we have politicians, we have members of parliament in Westminster, both in the government and also, on the back benches, prepared to throw away basic democracy. And they don't actually see the irony of this. I mean, it's just complete nonsense. This is 801 years since Magna Carta, which was the charter, if you like, that basically took power away from an unelected king and gave it to an elected body. Well, sort of elected body, the people, if you like. It was the landowners, if you like, at that stage. 801 years ago, and we're now chucking it out. For why? For fear that if we leave the EU, there's likely to be a downturn in the economy. Oh, come on. This is just nonsense. I mean, what's more important? Proper democracy or what? The standard of the debate is actually quite appalling. So that's my main point anyway.
That requires critical thinking skills to analyze, though, Alasdair.
Well, you say that. I'm not too sure that the skills are that critical, but they're just making a hell of a meal of the whole thing and missing out on the most important point. To my mind, the most important point is the loss of democracy. And if you lose democracy, then somewhere down the road, you're going to end up with civil unrest unless you find a way of backtracking on it. They're already seeing this in Europe. I mean, look at Greece. Spain, 50% unemployment for the youth. Italy, same sort of situation. France, complete discontent amongst the ordinary people, looking like Marine Le Pen, the the far right French lady. Looks like she's in the running for president or something. I mean, it's just nobody actually likes on the street level what is actually happening.
She's against the euro too. We should also note for our listeners.
Oh, yeah,
if she gets
absolutely.
elected, that's going to be really interesting to see what happens 2017 and beyond.
I'm afraid I hear what you're saying, but I'm afraid in Europe there is a history of people. They might be against this and against that, but once they get into the establishment tent, you find that their views modify. So, which is interesting, because I wonder if that's going to happen with Donald Trump if he gets into the presidential tent. But anyway, there we are.
As a parting shot, what's your take as a Brit when you look over across the pond and see our election season and all of its festivities with Trump and Hillary and Bernie and so forth? Is it much news in the UK?
It is, but the news element of it is obviously. I mean, you've got it every moment over there. We've got Brexit every moment, so I think the presidential election is slightly crowded out. But just observing it from here, I find that Donald Trump's approach has been fascinating, because you have to ask yourself, what is the objective of someone like Donald Trump in his campaigning? The answer is to get votes. And he recognizes how to get votes. And, that actually is all it is about. It's not about he believes in this policy or he believes in that policy. Someone who gets elected is someone who says what people want to hear. And he's got that message loud and clear. He understands it completely. So I would say that even though he has no track record as a politician at all, he understands the rules of the game to an extent which very, very few people in the game understand themselves.
He's definitely a master of public relations. Quite amazing to see someone who will shun a debate with a major network and basically tell them that they had to pay him $40 million because of raising the ratings for the show. I mean, he definitely has cojones, as we sometimes say.
Yeah, absolutely. I mean, I find it fascinating because he does things that no politician would dare do, and I should think probably would like to do, but he's actually got the effrontery to do it and get away with it. I mean, it is actually brilliant. I'm full of admiration for his campaigning. I'm not necessarily full of admiration for him as a prospective president, because I got no idea what he'll be like as a president, and I don't think any of us have.
Yeah, I think if nothing in Black Swan manifests on the political scene, as far as stories about unsundry control file elements in Trump's background or in Hillary's background or what have you, because these two are definitely going to go after each other, and this is going to be a very negative race.
Trump's already started this week. I mean, this week alone, he's discussed Vince Foster, he's discussed Bill Clinton, he's discussed Whitewater. I mean, this is May still.
Yeah, and
this is even before the nominations are in, I think, isn't it?
Yeah.
Yeah. Although Trump did officially get the delegate count to be considered the presumptive nominee, the official nominee for the Republican Party today, as a matter of fact.
Yeah. Good. Well, I don't think the Republican Party's got any option, quite honestly. Just have to take it. But Hillary's, it seems that the FBI are after her for, sort of doing emails on a private server and all the rest of it. And there's some bizarre story about how the Russians have got 2,000 emails, which they may or may not release. I mean, it's just... it's full of fun, this one, isn't it? I mean, it's quite extraordinary.
Yeah, it's sure shaping up to be an interesting...
like the Chinese curse. We live in...
Yeah. May you live in interesting times. Exactly. Yeah. Yes, indeed.
All right. Well, on that note, Alasdair, well, thank you for joining us. It's always a pleasure to have you back in the show and listen to your excellent insights on the markets.
Well, it's very kind of you to say so, and thank you very much for having me on. That was very kind.
All right, well, come back and join us again soon, Alasdair.
I would love to.
All right, for the doc, Eric Dubin, and our good friend Alasdair Macleod, thanks for tuning in to this week's SD Weekly Metals and Markets, and have a great holiday weekend.